Streaming from Oklahoma's own digital studio, this is Dave Davis with Your Money Matters.
Hello everybody, Dave Davis here. We're diving deep into the interest rates right after the Fed has voted in their September meeting to cut interest rates from 4.25 to 4%. The benchmark interest rate, they cut it by 0.25%. We have been talking with experts about what this means. Is this a good thing for our economy right now? What it could mean for you, credit cards, home loans, car loans, all the things that affect interest rates. So Tom Bennett III is here with us once again from First Oklahoma Bank. And Tom, we thank you so much for your time, and we really appreciate you being here with us today.
Yeah, thanks for having me.
Okay, so Tom, your first reaction, is this a good thing? Is this a bad thing right now where we are in this economy for the interest rate cuts?
Personally, I think it's a good thing. Interest rates have been high, and that's really weighed on consumers. Whenever they started raising interest rates, where all of us would have seen this in our everyday life is, if you had credit card balances, your interest rates went up. If you bought a house, the interest rate on the mortgage went up. If you had a car loan, the interest rate on your car loan went up. And so they were doing all of that, raising interest rates, because if you remember, inflation was kind of getting out of control. And so one of the things that the Federal Reserve does is they raise interest rates, and whenever things are more expensive, the idea is it slows the economy down. Well, it's been slowing down. You and I both know, and we can feel it. For instance, whenever you go to the grocery store, prices are high. You can see that economic activity is kind of slowing down. That's one of the things Chairman Powell brought up yesterday in his conference. And so, I think it's for the American consumer, it's a good idea that we start reducing the cost of borrowing money, because there's an enormous amount of borrowing going on, and that's really weighing on people's wallets.
Well, and I'm also curious too about when we're talking about making it cheaper essentially to borrow money, how that affects the job market, because to me, that also interplays with this. Obviously, Washington, that has been a big discussion with the jobs numbers, and talking about job market growth may have been slower than we thought. So how does this create jobs potentially by lowering the interest rate?
Well, I think you're absolutely right in terms of people being worried about the job market. They came back and revised down the total number of people that were employed by 1 million. And then the last number of jobs reports that have come out have really showed tepid hiring. Another thing that to pay attention to is the jobless claims rose. And so, things that we do need to worry about are jobs that people have. The idea of reducing interest rates is you drag economic activity forward. So if the rate is cheaper, then the idea is businesses or consumers will go ahead, and if they were going to hold off because prices were high, they may go ahead and then hire that new person. They might buy that new machine that then they can employ more people, employ more workers in what they're doing. And so that's kind of the concept on it. It'll be interesting to see how that works out.
I'm also curious about, with the Fed lowering the interest rates, how this affects, first of all, let's just talk with mortgages, because I know all these things kind of have a knock-on effect. Maybe not everything's right away. So how soon could we see mortgage interest rates drop, for example?
Well, this move and reduction in interest rates has been pretty telegraphed. And so over the last number of weeks, mortgage rates have continued to drop. So just the other day, mortgage rates were the lowest they had been in 3 years. And I expect that trend to continue to drop. Chairman Powell said, 1/4 point yesterday, there could be two more this year. And then I imagine they keep going. And so, I think if there's a checklist for you and I and all of your viewers, things that we need to be paying attention to, if we bought a house within the last, say, 3 years, I think rates will probably get down to where they're below in the 5% range again. If you bought it just a couple years ago, your mortgage rate's probably 7%. Why not save some money? Think about refinancing. If you carry credit card balances, each incremental reduction in the Fed's discount rate should help you, and that'll be good. If you bought a car in the last couple of years, which I've got a daughter who turned 16, I had to buy a car. Well, that interest rate is 7.9, and nowadays, whenever rates drop, you can bet that I'm gonna go refinance that and lower my payment, because whenever you're making a payment, a lot of it goes to interest. And while I'm a banker by trade, I'm a consumer too. And, I want to keep as much of my money as I can and have that go to purchasing power for me as opposed to an income for a bank. So it's just think about what you've got going on, think about your expenses, and then find ways that you can maximize the amount of money you can keep in your pocket.
So what I'm hearing is we have mortgage rates already were going down, and car loan rates, car loan interest, and mortgage or credit cards rather, those should be pretty immediate following this bench rate cut, if not already.
Most of them should be repricing probably today. Now, it's only a little bit because, we only got 1/4%. And so what we're looking for you and I is you're kind of looking for the curve. You want them to continue to kind of keep arching down, and that will continue to provide more relief for the American consumer and the American borrower.
I'm also curious with the interest rates, and you'd mentioned it earlier about the interplay with inflation. Jerome Powell, I believe at the same meeting, said he thinks inflation could go up to 3%. I mean, correct me if I'm wrong. That's what he said? It could actually continue to go up a little bit? So what does that mean?
Yeah, it could. And last month it did. Prices increased a little bit. And anecdotally, you and I kind of both can feel that already. I mean, if you buy something on Amazon, you buy it at Walmart, and you compare what it was a year ago, prices have gone up. That's true. I wonder if they're really going to come down too much. And I do think I share Chairman Powell's concern that the increase of prices have not yet fully made it through to consumers. If they haven't fully made it through yet, well, then that does mean our prices will continue to go up here for a while. Now, is it going to be some massive spike? No, I don't think so. But I can tell you that our business customers have been having to pay higher prices for inputs. And, you got to think of the cycle. So you'll order an input. It's going to take a couple of months to get to you, and then it'll take you time to put it together before you even sold it. So if you kind of think of the cycle, I think the economy is kind of still has some price increases to go because it is true that things cost more.
As we have discretionary spending here and there, maybe we get that third paycheck of the month. It's probably a good idea to start saving up for all these things, right? I mean, in interest rates being 4% as they are, down from 4.2%, but you can still get interest rate on your savings, right?
Yes, you can, but expect those to start to decline. Whenever interest rates are high, it's good for savers, and it's bad for borrowers. And whenever interest rates decline, it's not good for savers, but it's better for borrowers. To the extent that you get any extra money or you get a little bit of savings, one thing that I would 100% recommend people do is continue to build some sort of a nest egg in a savings account, because you just never know when something's going to happen. And if that transmission goes out, I can guarantee you it's more expensive than it was last year. And so to the extent that you get savings, we just got to look at ourselves and go, okay, so the right and reasonable, sensible thing to do is what? And that's continue to build our savings account, because you need to keep more of your own money. And so I make that a priority rolling into Christmas. And the Christmas gift I'm going to give myself is a little bit more money in my savings account.
Yeah, it's a great idea, and that's something that we can do regardless of interest rates. Always have that emergency fund, 3 to 6 months of your salary that's replaceable if it needs to be. That's something we can always do regardless of interest rates, and just enhance that with maybe like a money market, right, or something that bears interest, a savings account that actually earns you interest, where it's not just like sitting there like in a checking account, right?
Yeah, be smart with your money. It's yours. So like if it's your money, shop around, find good interest rates, find the service that you want. But if you just hold money in a non-interest bearing checking account, realize with inflation, you're losing money every single day, because the money becomes worth less every single month. That's what inflation is. So the dollar that you had 5 years ago doesn't have the same purchasing power that it has today. So the smart person will go, okay, well, I mean, this is a little bit of economics, and sometimes economics are a bit scary, but the thing that you can take away is money continues to decline. The Fed would like to have inflation only be 2%. Right now, it's running closer to 3. And, frankly, depending on what you're buying, it's running higher than that. I heard a story earlier this morning where, ground beef is 14% up from where it was 1 year ago today. Now, that has to do with the smaller U.S. herd size and things like that. But the fact of the matter is, it's more expensive. And so, like if you have cash sitting around, don't put it under your mattress. That you're losing money doing that. Go find your local bank. Go put some money in your local bank and get some interest. You deserve it.
You're the CEO at First Oklahoma Bank, and I know that your time is very valuable. So I just want to give you the floor here at the end of our time. Any last thoughts on the interest rate cuts and what could be coming in the future?
I would tell people, I am a little bit worried that things are starting to slow down. I think the number of unemployment claims that are going up, that kind of makes me a bit nervous. And, thinking about jobs, thinking about the job you currently have, thinking about jobs that you may or may not want to move to, I would encourage people to, this is probably the right time to start battening down the hatches. And, if I'm wrong, then what was the worst that happened? You saved a little more money? That's a good thing. If I'm right and it slows down, then you may need it. And so I would urge people to be cautious. Just because rates are declining and you may not be paying as much out in interest expense, normally that's not the greatest sign. Normally that's a sign that, hey, the economy is slowing itself down and we all need to make smart decisions so that we protect ourselves and we protect our families. And so I would probably encourage everybody to think about what the next 12 months looks like. Make sure that you have a savings account. Make sure you're building up as much cash as you can, because the worst case scenario, you prepared. And you prepared for something that didn't happen, and you're still better off.
Tom Bennett III, thank you so much for your time today. We really appreciate it.
Thanks for having us. I hope you guys have a great day.
And we'll see you back here on the News on 6 digital desk soon. Thanks for joining us on YouTube, on newson6.com, and on TV.
Thank you for watching this Oklahoma's own digital studio stream. Stay with News on 6 online and on television anytime for the latest news, weather, and sports.